Title: Navigating the Seas of Market Sentiment, a Guide to Avoiding Herd Mentality. Introduction. In the tempestuous realm of financial markets, the currents of market sentiment can be as influential as the economic fundamentals that underpin them. Navigating these seas requires a keen understanding of the forces that shape investor sentiment and a steadfast commitment to avoiding the siren call of herd mentality. In this guide, we unravel the dynamics of market sentiment, exploring strategies to stay afloat amidst the tides of collective investor behavior. The nature of market sentiment. Market sentiment is the collective mood and attitude of investors towards a particular asset, sector, or the market as a whole. It is a potent force that can propel stocks to dizzying heights or plunge them into abyssal lows. While grounded in economic factors, sentiment is often driven by emotions, perceptions, and the herd instinct of investors. Understanding the factors that influence sentiment is crucial. Economic indicators, corporate earnings reports, geopolitical events, and even social media trends can shape the prevailing mood in the market. Recognizing these drivers enables investors to gauge sentiment accurately and make informed decisions that go beyond the allure of the crowd. The pitfalls of herd mentality. Herd mentality, characterized by the impulse to follow the crowd without independent analysis, is a pervasive threat to rational decision-making in the financial markets. While there is comfort in moving with the herd, it often leads to exaggerated market movements, bubbles, and, ultimately, disillusionment. The history of financial markets is replete with instances where herd mentality resulted in speculative frenzies followed by precipitous crashes. Consider the dot-com bubble of the late 1990s, where investors, driven by the fear of missing out, FOMO, flocked to internet-related stocks, bidding up prices to astronomical levels. When the bubble burst, those who succumbed to herd mentality suffered devastating losses. Learning from such historical episodes is essential for investors seeking to navigate the treacherous waters of market sentiment. Contrarian thinking as a beacon. One effective strategy for avoiding herd mentality is embracing contrarian thinking. Contrarians swim against the current of popular sentiment, seeking opportunities where the crowd sees risks and vice versa. This approach requires a mindset that values independent analysis over consensus views and is willing to withstand the discomfort of being out of sync with the majority. For example, during a market euphoria where everyone is rushing to buy a particular stock, a contrarian investor might pause to question whether the valuations are justified. By maintaining a critical perspective and avoiding the temptation to blindly follow the crowd, contrarians position themselves to benefit when sentiment inevitably swings in the opposite direction. Psychological resilience in the face of noise. The constant hum of financial news, social media chatter, and market punditry can create a cacophony that drowns out rational decision-making. To navigate market sentiment successfully, investors must develop psychological resilience and the ability to filter out the noise. For instance, during periods of heightened volatility, sensationalist headlines may stoke fear and panic. Investors who succumb to this emotional turbulence may make impulsive decisions that go against their long-term strategy. Building a mental fortress against such noise involves staying focused on fundamentals, maintaining a disciplined approach, and tuning out the short-term market hysteria. Analyzing behavioral finance. Understanding the principles of behavioral finance provides a roadmap for navigating the psychological nuances of market sentiment. Behavioral biases, such as loss aversion, overconfidence, and recency bias, can lead investors astray. By recognizing these cognitive pitfalls, investors can cultivate a heightened self-awareness and make decisions grounded in reason rather than emotion. For instance, the fear of losses may drive investors to sell hastily during market downturns, missing out on potential recoveries. Recognizing this bias allows investors to adopt a more measured approach, potentially avoiding the pitfalls of panic selling during temporary market fluctuations. Long-term perspective and disciplined investing. Maintaining a long-term perspective is a bedrock principle for avoiding the pitfalls of herd mentality. While short-term market fluctuations can be driven by sentiment, the fundamentals of a well-researched investment typically play out over the long term. Investors who anchor themselves in a disciplined, long-term strategy are less susceptible to the whims of short-term sentiment and are better positioned to weather market storms. Consider the legendary investor Warren Buffett, whose approach is grounded in the idea of buying quality companies with a long-term horizon. His success is a testament to the power of disciplined investing that transcends the noise of short-term market sentiment. Conclusion. In the ever-changing landscape of financial markets, mastering the art of navigating market sentiment and avoiding herd mentality is a skill that sets successful investors apart. By understanding the nature of market sentiment, embracing contrarian thinking, developing psychological resilience, analyzing behavioral finance, and maintaining a disciplined, long-term perspective, investors can steer their portfolios through the stormy seas of market sentiment with confidence and poise. This guide serves as a compass, guiding investors towards the shores of rational decision-making in the face of the tempestuous tides of collective investor behavior.